John Plassard joins us now, Deputy Director at Mirabaud. John, we've seen the market very much concerned around inflation and any triggers for a taper or interest rates rising down the track. You've spent a lot of time writing about a taper. Do you think we're setting up for a taper tantrum in the near future?
Hello, thank you for having me on the show, Karen. But I believe that the taper, if and when there will be a taper, it will be a real relief for the investor, because the Fed will progressively normalize the monetary policy for good reasons. So higher inflation, lower unemployment rate, and tremendous economic growth. So the longer, it's what I think, the longer the Fed does nothing, the more likely it is to lose control of inflation altogether. And so we expect that within the next few weeks ahead of the Fed September meeting, or even in August with how do you call it? There is another meeting just before September in August in Jackson Hole, sorry. The narrative will change accordingly. So as you might know, you better be ahead of the curve than behind the curve. So that's what that's why I believe. I believe that it will not be a shock for the market. I believe that tapering is a good thing, and I believe that we can live with higher rates and with lower assets to be bought by the Federal Reserve.
An orderly playbook for markets would no doubt be welcome, but in the past, when we've seen a change in policy, things have not always gone that smoothly. And if you think about the amount of herding and certain positions that we've witnessed in recent years, it does have the potential to ratchet up volatility on the back of a policy decision. How safe is technology then?
Technology is a special animal, I would say, because technology is also at one point related with real rates, and actually we experienced that real rates are not moving, even going lower. So there might be some pressure on this sector if, let's say, the US 10-year yields reach 2 to 2.5%. But I think actually that the forward guidance that the Fed members are providing is completely different than what we experienced in 2016. And I remind you, Karen, that we were in the same situation 6 years ago when US rates were at the same level as today, so 0.25, and those rates have gone up from 0.25 in December 2015 to 2.5 in December 2018, with an increase of more than 25% for the S&P 500, and but especially nearly 45% for the Nasdaq. So I think that maybe it could be a shock when the tapering will be announced, but I don't think it will last. And the past is telling us that we can live, and also this sector can live with higher yields and higher rates.
John, the problem with that is, I think in your sentence, the past tells us that we can live with higher rates. What about now? Because as I look at the CLO market, we're at a 16-year high. That's $760 billion of fresh bundles of risky loans. We have corporate leverage at highs. We have borrowing to buy stocks at highs on leverage. Everywhere you look, there is debt. It reminds me a lot more of Japan than it does of a new world where we can see higher rates. What are the chances actually that this inflation story might just be a head feint and that we are stuck with low rates for decades?
I think we're in a different situation, Jeff, here for several reasons. First of all, because it's a historical problem, sanitary problem that we had there. And last time it happened, it was 100 years ago with the Spanish flu. So I don't think that looking at what happened in Japan is the right way to look at inflation now. And I think that the problem, and totally agree with the members of the Fed and the ECB arguing that there might be transitory inflation going through, as you might know, the energy prices, higher energy prices, and the service sector. But don't forget that what we call the second round effect is something that will last. You know, it's the result of producers passing on the increasing cost to their consumer by raising prices, and on the other hand, and I think this is the most important, employee demand a compensation increase in remuneration. And we didn't have that in Japan. And you were talking about debt. And I think, and I repeat myself, we are in a specific and extraordinary situation, actually, and that the debt is not a concern for the government. It's not a concern for the Federal Reserve. And Jerome Powell said exactly the same that Mario Draghi said it in 2012, whatever it takes. They will do everything to save the economy, everything to save the economy to collapse. So I think the return of growth will be much more higher than expected, and then we can talk after about debt.
John, I mean, clearly from what we're continuing to discuss here, there is a great deal of fog of war going on, and it's difficult to discern which way this is actually going to go. Can you find me a non-correlated asset to the interest rate story, something I could buy and feel comfortable locking away in a safe or holding in an account that won't worry me or give me too many sleepless nights as this volatility plays through the rest of the year?
So you might be maybe a bit worried, but because it's a non-consensual call, and this is the dividend call, and I know that return to growth, return rising inflation, so these factors present today are not normally render the dividend story. But as we saw, corporate dividend had made a big comeback since the start of the years, and many companies are starting to redistribute dividend, with some considering increasing them. So there are several reasons to stuck to that non-consensual call. First, the search for assets that best combine stable income with limited risk amid the return of inflation. So it will make a big comeback. And another argument for buying high dividend stock is the number, and nobody's talking about them, but the baby boomer retiring. So those people looking to leave another 10, 20, 30 years will increasingly turn to this type of segment, so with low volatility. So, and we know that historically, dividends tend also to benefit during phases of economy recovery when corporate profits are rising. And that's actually the case, Jeff. So the sector I will stick and I will look at in the dividend field will still be cyclical and value play. Sorry. Go ahead.
No. Great answer. I think what Jeff was alluding to, because there's a curious line in the copy we've been sent by our producers, says, "Why should we invest in art? ? Note attached." I couldn't find the note, but are you saying, as well as our dividend play, Jeff should put in his enormous safe some pieces of art?
Yes. It's art is an amazing investment for several reasons. If you look at the 25 last years, it has a better return on investment than the S&P 500. So S&P 500 8.9%, over the 25 past years every year, and the art, the contemporary art, 13.6%. And so art has also low correlation with other classes, so it's a unique investment, and you have minimum losses if you choose the right one, of course, Steve. If you look at during the last past 25 years, contemporary art has recorded loss of only 4% on cases over investment horizon of 3 years. So historically, contemporary art had also helped you protected the theme of inflation. And there is a lot of growth to come. And I really believe if you choose the right one and you can invest in art in several ways, that could be also a good investment.
John, I've been pondering the artwork behind you. Any names you want to throw to us so I can stop searching?
No, I'm more I'm more an investor in on the stock market than in art. But I know that art, you can choose some art funds, and also and maybe Jeff, you have some of contemporary artwork in your living room. That's another way to invest in art. And also now, and this is very interesting, you have advances in blockchain technology have given us, tokenization, what they talk, which make it possible to buy part of piece art. So there are many ways to invest in arts, and I think it's quite interesting. It's something you have to look at as well as the dividend play in this field of inflation and new inflation, and inflation here to stay longer than the central banks might think.
John, thank you very much for joining us. John Plassard with us, Deputy Director at Mirabaud.